Well, we are exactly 2 weeks away here from the Fed's next meeting. Consensus is that it will hold steady, but the optimism over the first rate cut in March is slipping. Markets now at a roughly 57% probability the Fed cuts in March, which is down 10 percentage points from just last week. And our next guest says one risk for the market is keeping rates too high for too long. Joining us now is Kevin Mahn, Hennion Walsh Chief Investment Officer. Kevin, it's always great to have you on the show. Thank you for joining us.
My pleasure.
So help us make sense of it, Kevin. So what are your expectations for the Fed in 2024? When do you think they're going to cut, Kevin, and by how much?
Sure. We'll start with what the Fed's expectations are. As it stands right now, according to their most recently released dot plot chart, 3 cuts next year of 75 basis points, another 100 basis points in cuts in 2025, and yet another 75 basis points in cuts in 2026. What I find interesting is that they're forecasting GDP growth to slow to 1.4% next year. They're also forecasting inflation to stay at 2.4%. So if they're going to be cutting interest rates this year, when inflation doesn't come back to their magical 2% target, it tells me they're more concerned about this economic slowdown potentially moving into recessionary territory than they are worried about inflation staying above 2%. Where am I? I'm in that 4 rate cut camp, 25 basis points each, likely not starting until the second half of the year. The Fed needs to see 2 consecutive quarters of a slowing economy before they can feel good about actually cutting interest rates.
But where do investors look for clarity on that? Because I'm not seeing the slowdown, and my sources that I've spoken with today who are now reversing their calls on a June cut are saying that they don't see the slowdown either, and they're worried that that's why the Fed is going to have to go higher for longer.
Sure. If you look at the GDP Now estimate, the most recent one from the Atlanta Fed, they're forecasting fourth quarter GDP to slow to 2.4%. Still good growth, but much lower than third quarter, 5.3%. Then looking at the Fed's own projections for GDP, 1.4% this year and staying below 2% all the way through the end of 2026. If that is in fact true, that is an economic slowdown. How does that economic slowdown actually turn to a period of economic growth? The Fed starts cutting interest rates, providing, of course, that inflation continues to moderate. So we're going to have to see the proof of that economic slowdown over these next 3 quarters. But according to the Federal Reserve, it's coming. And it's an intended consequence of all those aggressive rate hikes that they put in place since March of 2022.
And Kevin, should it matter to investors when they start cutting? Does it matter if it's first half or back half?
I'd be very reticent to tell individual investors to try and play the Fed guessing game. I've been doing this for over 3 decades. I don't play the Fed guessing game well, but I think it's fair to say over the next 3 years, interest rates are going to be lower, yields are going to be lower, inflation should be lower, and economic growth should start to moderate. So with that type of outlook in mind, investors should start positioning their portfolios today for what's likely to happen over the next 3 years. Don't think so short term. Don't think about today, this week, or this quarter. Think over the course of the next 3 years to the next decade. And there's tremendous opportunities in both stocks and bonds that haven't participated in the rally that took place last year, which was largely accounted for, of course, by those 7 large cap technology stocks.
So where do we find that opportunity outside the 7? The $1 million question, right?
So we've done the research at Hennion Walsh and Smart Trust, and it suggests that there are 3 sectors that have historically performed best during periods of economic slowdowns: healthcare, consumer staples, and industrials. Notably aerospace and defense, an area where there's going to be significant investment in over the course of the next decade. However, during the second half of the year, when interest rates actually start to decline, you might want to start leaning into areas such as technology and financials, those beaten up areas of the banking system thanks to the fallout from the regional bank collapse in 2023. That's where you want to start positioning as interest rates start to decline. But investors would be wise to, once again, not try and time the market. That's an exercise in futility. Stay in the market, give yourself downside protection, and lean into those areas of market that should provide for growth. If you're looking for income, look at investment-grade municipal bonds, preferred securities. Extend duration now. As interest rates come down on the short end of the curve, the opportunities become on the long end of the curve. Start positioning now for that likelihood.
And Kevin, I'm just interested as a strategist, as a professional investor, how you think about geopolitical risk, and particularly, the Iran-Hamas war. It's obviously spread. You see Hezbollah, you see the Houthis really having this tremendous effect in the Red Sea, effectively upending international commerce. To what extent, how do you think about that as a strategist? And do you see kind of upside risk of that geopolitical conflict in terms of inflation?
Sure, that's the other big risk that I see for 2024. Not only does the Fed stay too high for too long, but do certain of these geopolitical risks continue to escalate and pull in other countries throughout the world? What type of disruptions do they have in the supply chain? Are they actually inflationary in nature? Tremendous risks that are in place, and there's going to be more volatility in 2024 as a result than there was in 2023. And then, of course, there's a pretty big presidential election coming up with some big economic consequences as well, which could add only more volatility to the equation. So investors would be wise, once again, to work with their financial advisors, make sure their portfolios give them the downside protection that they're looking for, staying true to their risk tolerance, but also trying to meet their growth and their income objectives.